Okay, this is recording. So after we finish this, I can share the recording to the Telegram group, or maybe I can also posting on my YouTube channel. Okay, okay. This is risk. Okay, and here we have three measures of the project risk. So risk that associated with the project. The first one, as we call it, is the project standing alone risk. So this is the project risk that ignoring the fact that much of the risk will be diversified away that the project is combined with this other project and asset. Okay, so the risk will be diversified away within firm as this project is combined with other projects. So basically in here, in the project standing alone risk, the risk project is measured by the variety of expected return. And then they ignore the project, the fact that it is the only one of many projects within the firm. So basically the firm is only have one project here. So this is not recommended when you have to diversify the risk. Remember that in finance, there is an idiom that say, don't put your egg in one basket, which means that if you want to invest into something, then don't invest only one if you're not really sure with that. Okay, and in the money market, let's say if you want to buy the stock in the stock market, but don't start the stock now. I have a couple of stock that the value is almost cut into half, you know, because the situation, the economic situation right now is not really good, even if you want to do some projects, probably. Okay, the second one is called the project contribution to the firm risk. This is the risk diversified away by the shareholder as securities are combined to form diversified portfolio. So in this project, you also combine between one project and also you use other method of the project, which means you invest in the other's portfolio or other asset, which means probably in the capital market, something like that. So the amount of risk that the project contribute to the firm as the whole, this is measured. Consider the fact that some of the project risks will be diversified, only some. Okay, and as the project is combined with the firm other project and asset, but ignore the effect of diversification portfolio. So they ignore some of the firm shareholder. So the last one is called the systematic risk. Okay, the systematic risk is the risk of the project measured from the point of view of the well-diversified shareholder. So you actually, in this systematic risk, is willing to increase the shareholder value at this time. So it is the project risk taking into account that the fact that this project is only one of many projects within the firm and the firm's stock is but one of many stock within the project. So you have many projects here and also you have many stock in the stock market. So not all of the money you pour into the project, but also you diversify away to some other portfolio which is in the stock market. Okay, this is the three measures of the project risk. Okay, and then this is incorporating risk into capital budgeting. So basically in this chapter, we don't really much studying about other topic, which is in this situation, I think this is really good because I have the limitation in presentation using the Zoom because this is the free. I'm actually want to buy it, but then it's only one more meeting. I think we still left, which is not worth it. I think. Okay. This is the two methods that I explained at the beginning of this presentation. If you want to incorporate risk into capital budgeting, which means when you want to consider the risk when you calculate the capital budgeting, then you have two methods here. The first method is called the certainty equivalent approach. Okay, in the certainty equivalent approach, you actually have what the so-called in here a beta or alpha. Okay, you have certainty equivalent coefficient. Okay, that coefficient is actually coming from certain cash flow, okay, divided by risky cash flow. So in here you're comparing between how much money that is saved as a cash flow to you, and then compare with the risky cash flow. So not all of the risky cash flow will be considering in this certainty equivalent approach. Okay, check my battery. Hold on. Okay, and then in here, in this certainty equivalent approach, it's involve a direct attempt to allow the decision maker to incorporate with the utility function into the analysis. Okay. So basically, there's an explanation in here, but I think I just jump into in here another explanation. Okay, you have two here: certainty equivalent approach and the risk adjusted discount rate. Okay, this is the calculation. How can we adjust this model to take risk into account? Okay, so this is like the usual net present value from the chapter 9. Okay, you have the free cash flow after tax at the time t, and then you divide it 1 plus, this is k is expected return. Okay, and then square t. This is minus IO. IO is stand for the initial outlay or your first investment. Okay, let's say if you want to buy a machine, then the initial outlay will be include the price of the machine itself and also the installation fee of this. So this is after you calculate this, then you have to subtract with the initial outlay, and then you can find the net present value. If the net present value is positive, then you can go ahead with the project. But if the net present value is negative, then you don't have to do it, because your value in the future after you discount it using present value is actually when they subtract with your first investment, it come up with minus. If it's minus, which means that you're not expecting the profit, but if minus is the sign of your loss. Okay. Okay, this is how you adjust this model to take the into the risk when you adjust risk adjusted model. Okay, so adjust the after-tax cash flow or after-tax cash flow, or you adjust the discount rate. This is the after-tax cash flow. This is the discount rate. Okay, you can adjust either this or this. If you adjust this, then the value of the net present value usually higher. But if you adjust this, let's say if you increase the value of K, then the value of net present value usually decreasing, or it might be minus here. Let's say if you consider between 10% and 15%. If this is 10%, the value of net present value might be positive. But if you increase, because you think probably the risk increase, has associated with the risk. If the risk increasing, then it's supposed to be increased. So remember, high risk, high return, low risk, low return. Okay, so first you adjust the tax, this one, free cash flow, you adjust the free cash flow, or you adjust the discount rate. Okay, this is the certainty equivalent approach, the first one, to calculate the free cash flow, the net present value. The first step that you need to do is to adjust the risky after tax cash flow to a certain cash flow. So adjust this. The idea is like this. This is only the idea or the example. So the fact is, to simplify this, I think the value of this factor or this is coefficients will be given in here. Okay, first you adjust the risky after tax cash flow to a certain cash flow. So this is the idea. Let's say this is your risky cash flow. Okay, okay, and this is the not risky cash flow. This is called certain cash flow. Okay, this is the certain cash flow. So let's say your risky cash flow is 1,000 and the certain equivalent factor is 0.70. So the highest value for this is 1.00. Okay, which means that if this is 1.00, you multiply with this also the same. But if you, this is like an adjusted, okay? When you adjusted this with the risk, then you have to multiply with the certain coefficient. This is the certain equivalent coefficient. Okay, and this is your cash flow. Let's say you consider that your project, okay, this risky cash flow from your project will be risky, then you think that's probably the certain cash flow that will be saved to you is only 0.70%, then this is your safe cash flow. So if you use this approach, then the cash flow that you need to consider in the future is this cash flow instead of this. This is too risky because you think your project will not get this amount of money, so that's why you adjust with this. Then this is the safe for your cash flow. The reason you need to adjust it, remember that what matters to the company is not the not the profit itself, because the profit is happen at the end of the period, usually December, okay, at the end of December. But what matters to the company is the cash flow itself, okay? Because in cash flow, if you have money in, if you have a lot of money in instead of money out, then you can spend the money for your, let's say, working capital. You can invest your money into land, or you can buy the new plan, and you can buy probably the new machine. When you buy a new machine, then you can produce more. So it's more active for your company to have your own. So that's money in has to do with the money out. So that's why if you have a good planning in cash flow, then it will be safe for you and you spend your money in the capital expenditure of the company. Okay, this is like an overview, but after I finish with the slide, I will give you how to calculate using the Excel program. And I will share it to you, the Excel program, using the probably the Telegram. Okay, this is another example. This one is close to 1, okay, the equivalent or the coefficient, which means that this project is not as risky than the previous one. If this one is 17, 0.70 is considered high risk. So that's why you adjust with this value. Okay, this is considered as a high risk. And the next one is this is not too risky. So if it's not too risky, then you can adjust with a higher coefficient. Using higher coefficient with the same amount of cash flow, then you will get a even higher safety cash flow. So the previous one, you only have 700, but this one you have 950. So remember that high risk, high return, low risk, low return. Okay, because this is not too risky, then you can save. Sorry, I get confused because this is too risky considered at the previous one, so that's why consider this as a higher safety net. Okay, this is from the certainty equivalent approach. Yeah, this is the summary from both of them. The greater the risk associated with a particular cash flow, okay, the smaller the CE factor, the coefficient equivalent, the certain equivalent coefficient. Okay. The greater the risk, if the risk is higher, let's say, then the CE factor, like this one, like the previous one. We still have 10 more left to go. After the 10 more minutes, I have to start with the new session here. Okay, like this one. This has a smaller CE factor. That's because you have the greater risk compared to this. So this is lower risk. Sorry, so that's why you have a higher 957. Okay, so the greater the risk associated with particular cash flow, the smaller the CE factor. So because you have the smaller CE factor, so the end result for the certain equivalent approach, the cash flow might be lower because you multiply the risky cash flow with the smaller CE factor. Okay, next. Okay, this is the certainty equivalent method. Okay, the HCF is the after cash flow, after tax cash flow, then you multiply with this. Okay, this is coefficient of the certainty equivalent coefficient. Sorry, this is alpha. Yeah, you have alpha here. Okay, so the alpha could be less than 1, like 0.70 and 0.90. And then you subtract with 1 plus expected return, or KRF. RF is risk-free. Risk-free, the example for the risk-free is like the government bond interest or the government bond yield or the term deposit interest. If you put your money in the bank in the time deposit, that will be considered as risk-free. Now in Indonesia, the risk-free if you put your money into the bank account, the time deposit, probably less than, probably for 1 month, the interest somewhere between 4.5% until 5.5%. That's considered as the risk-free. So you adjust this with the risk-free, not with your expected return. So, okay, you have to make a difference between the expected return and your risk expected return, with this risk-free expected return. And then you subtract with the initial outlay. Okay, this is the step, okay, the step to the certainty equivalent approach. The first one, you have to adjust all after-tax cash flow by certainty equivalent factor to get certain cash flow. okay, the after-tax cash flow, which is actually the net income. Not the net income, but the cash flow after you paying taxes. And then after that, you discount a certain cash flow by the risk-free rate of the interest, not your expected return here. Let's say if you have an expected return of 10%, but the fact is the risk-free rate is only maybe 5%, and you have to discount with this risk-free rate, okay? This is more conservative, actually, if you want to know for the cash flow, for the certainty equivalent. The certainty equivalent actually is, this is conservative for your cash flow, but this is considered as a safe, okay, when you want to plan for next capital expenditure. Okay, this is incorporating risk into capital budgeting. The second one method is called risk adjusted discount rate. Okay, when the risk is higher, then you have adjust discount rate to be higher. Okay, because high risk, high return. When the risk high, you have to get higher return. But when the risk is low, then you can adjust with the lower discount rate. Let's say if the lower discount rate is 10%, then you multiply with the 10%. But if the higher discount rate is 15%, then you have to multiply with the 15%. So this is the risk adjusted discount rate. The calculation is the same like the previous net present value calculation when you learn on the chapter 11, calculation of the risk adjusted discount rate. It's only you have to adjust the value, okay? Excuse me. How can we adjust this model to take risk into account? Okay, this is net present value, this is after cash. So you don't need to multiply with the coefficient, okay, because you don't need coefficient here. The only thing in here, you can adjust this expected return, whether increasing or decreasing, the K instead of the cash flow. The previous one is the cash flow because you have to adjust with the alpha. And the alpha, if it's alpha less than 1, then this value must be less than this value, okay, after you adjust it. Okay, and here you adjust the discount rate. This is the discount rate. You simply adjust the discount rate to reflect higher risk, higher discount rate. If you have the higher discount rate, then it will affect the value of, it will decreasing the amount of net present value. Riskier project will use higher risk adjusted discount rate. Okay. And then you calculate net present value using the new risk adjusted discount rate. Okay. This is adjusted discount rate. Okay, let's say this is star, K star. Okay, then how do we determine the appropriate risk adjusted discount rate to use? Okay, many firms set up risk classes to categorize different type of projects. So this is the categorizing here, these classes. Okay, this is risk. RADR is stand for the risk adjusted discount rate. This is risk adjusted discount rate. This is the project type. Okay, number one, class number one. If you only replace the equipment, then you adjusted risk, let's say 12%, for example. Okay, you set your required of return is 12%. Okay, 2 more minutes. Okay, and also if you expand your current business, okay, you still have your own business, the same business, only 12%. But if you related new product, let's say if you produce milk now and you want to produce cheese, then when you invest into this project, you have to increase this discount rate. Okay, should be 40% because this is more riskier than this. This number 3, if you produce, what the so-called unrelated new product. Let's say you produce, if you usually produce milk, and then the related new product is, let's say, cheese, and then you want to produce, let's say, bread. Okay, bread is unrelated new product as well. It's still related, but not too related. Okay, then you have to set this to be higher compared to both of these, so 60%. And the last one, let's say, if you want to project of research development, then it should be higher, 24%. Let's say if you want to find the virus and the antivirus for the COVID-19, then you have to spend more and more money in here for the research and development. So, and the result is not really sure. Okay, I think this is the end of the first session because my time is less than 1 minute. I will go back to you after I share another one. Okay? Wait.